Hi, this is Alan Gassman, and I am here to tell you about our single client module in the EstateView estate planning software library. I go to open EstateView by going to estateview.link. I put in my email address, I put in my password, and if my client is a single individual who wants comprehensive planning and has estate tax issues, or maybe even without estate tax issues, I simply click on single client. Now, when I click on single client, I have three different columns of display. The left column is my inputs and decision making as to what I'm going to show. The middle column is the display that shows the results for each particular planning scenario. And on the right column, I can select the result scenario that I want to show. So for example, to oversimplify, so you see this in progress, on the left-hand side, I've inputted the name of the client, the age of the client, how much they save or spend each year, how much their assets are worth, asset growth, et cetera, et cetera. On the right-hand side, I can click on dies in year one without planning, and I see value of assets today, and on death in year one, and an estate tax of $7,900,000. But if no planning for 15 years, I click on the right-hand side, no planning for 15 years. Now, because of growth, you see a much larger estate and a much larger estate tax of $23,000. So how specifically can this work out for your clients? First of all, for the inputs, I can use the left-hand side and input them, or I can make them bigger so that it's more convenient by clicking on these four opposing arrows. So once I've clicked on the four opposing arrows, now I can decide which strategies I may want to show by clicking the boxes for each of the charity I want to show. I can put in my name as the planner. I can put in the name of my law firm as the firm name. Oh, I got them backwards. So law firm, okay, and planner name, Alan Gassman. And then I can put in the client's name, Sam Singh. And I can put in the client's date of birth or just the client's age. If the client is 70 years old, I can just toggle to 70 years old. Male or female, whether or not a tobacco user, and this will tell me an approximate expected year of death. 10 years for a tobacco user, and 12 years for a non-tobacco user. By the way, these are based on standard life expectancy tables, and affluent clients who take care of themselves tend to live a lot longer than this. So maybe I'll let him live 18 years. How much of his exemption amount has been used in the past? We could say 0, or we could say he's made $1 million in reportable gifts in the past. Is he saving money from income that is external, such as a job, or is he spending money? And we will say that he is spending, let's say, $300,000 a year until he reaches age 80. And then at age 80, his spending may slow down to $250,000 a year. If I want to know how much life insurance would cost on him, I can click there, and that will take us to our life insurance scenario. So I can see an age 70-year-old for $1 million of coverage. It would cost between $16,000 and $10,000 a year for a 10-year term if he was interested in that, assuming non-smoker. That would be a typical rate. He's not interested in life insurance. And then if he is a widow or a widower, then I can have a bypass trust. It might be the Joan Brown Trust. And Joan may have left him in that trust $2,500,000. And then Joan may have left him a portability allowance. She didn't use her entire estate tax exemption, and maybe she left him a $4,250,000 portability allowance. Now, if he remarries someone who dies before him and leaves him no allowance, then there'll be no portability allowance. It'll go back to zero. But for now, we'll just go ahead and show a $3,250,000 portability allowance. Then the big question is, will the exemption reduce by half in 2026? You can say yes or no, and then later on you can change that to compare the results. Estate tax rate 40%. We do not cover state estate or inheritance taxes, but if he is in a state that imposes a 5% state estate tax, you might get an approximate or approximation of the situation by putting in 45%. What's your guess on what the chained inflation will be for the exemption and annual gifting allowance to go up each year? We're guessing 3.71%. What is inflation really going to be? We're guessing 4.26%. And now what is his asset base? Maybe he has $32 million of invested assets. Maybe they're growing at 8% a year on average. Maybe they cost 0.4% a year, and his income tax on dividends, interest, and capital gains might be 2.5% a year of the value of that portfolio on average. We also ask, is there an explosive asset? You know, sometimes clients come to us and they say, well, I have a business as part of my 32 million net worth, and it's worth 3 million today. But in 5 years, I expect to sell it for 10 million when I get this patent. And I'd like to get this company out of my estate if I can. In fact, maybe it's going to sell for 11 million. And when that happens, there's going to be 3 million of federal estate tax on the sale. So I can load in that explosive asset and also decide if that asset is going to be involved in the installment sale. For now, I will say no. My next input is, what is the value of the residential real estate? And let's say that there's a house or houses worth $3 million that will appreciate at 4% a year. So now the question is, do I want to do a qualified personal residence trust? I can do one qualified personal residence trust. I could place the entire home in a qualified personal residence trust. And if I do that, I can select a term for the CUPERT. Maybe I'll select an 8-year term, and that will use $1.6 million of the estate tax exemption, but get the entire home and growth out of his estate for estate tax purposes. And then after the 8th year, he can start paying rent for use of the home, and we'll assume that his rent rate will be 6% of the value of the home. He may have 2 children now and expect to have 6 Crummy Powers after 6 years, for example, or 4 Crummy Powers after 6 years. He may have an LLC that he can use to make discounted gifting. And let's just see where we are so far with him. So I click on the red cross type thing. My inputs went back to the left. And now I click on dies in year 1, no planning. By the way, these images that you see on the right-hand side, if you prefer just to have buttons, you click that check mark there, and now you just have a button for each of the different strategies. Not as fancy and more concise. So if he dies this year with no planning, he's going to have a $9,700,000 estate tax. The trust left by his spouse is going to be worth $2.6 million. So his descendants are going to receive $33 million. If he dies in 18 years with no planning, I will click on that on the right. Now his estate tax, $31 million, credit shelter trust, $6.1 million, and total passed to descendants, 69 million. If he will go ahead and do the CUPERT, Qualified Personal Residence Trust, I click on CUPERT. When I click on CUPERT, it shows me the home is moved to the CUPERT, and that in 18 years, the home will be worth $6,077,000, and the cash reinvested from rent at the rate of return I chose, minus the taxes that he's paying out of his estate, brings the cash in the CUPERT to $4,020,000. The CUPERT is disregarded for income tax purposes, so it pays no income tax, so that's helped to reduce his estate. So that CUPERT brings the estate tax down to 28 million. So just to show you again, with no planning, 18 years, estate tax 31 million. With the CUPERT, the estate tax is 28 million. And a lot of this CUPERT savings is getting $4 million accumulated from rent paid. Now we have a separate CUPERT calculator that will go into a lot more detail and fine tuning on CUPERTs, but this helps a CUPERT at least be illustrated during someone's lifetime. Now, what if he does the annual gifting? I click on annual gifting, and now I have an irrevocable trust on the right. And in year 18, that trust has $2 million in value in it that passes free of estate tax. The estate tax is down to 27 million. What if he can transfer discounted LLC interests using a 30% discount? I click on that. Now the gifting trust goes from 2.7 million to 3.9 million. The estate tax goes down to 26 million. Now, let me mention a couple of more features as you become accustomed to this. Whenever I click on something on the left, like CUPERT, you'll see that it will appear on the, when I click on something on the right, like annual gifting, you'll see that gifting appears on the left-hand side. Also on the left-hand side, these blue words that I'm pointing to are shortcuts. So if I want to get to investments quickly, I click on investments and there they are. But I can also click show hide, and now I just have my inputs and I don't have those shortcuts. So I'll click that again to show you there's your shortcuts. And if you prefer not to use the shortcuts, you click on show hide. In addition, the view I'm showing you here, let's say with the CUPERT, is the logistical view. Across the top, I also have something called a timeline view. When I click on timeline, this is showing me each year that he may die and what the estate tax would be each year that he may die. And the green is his business and investment assets. The red is the part of the investment assets that would be gone to estate tax. The qualified personal residence trust is this dark green here that escapes estate tax. And then the bypass trust is what they call the custom trust across the bottom. In addition, if I click on details at the top, it gives me some of the key details that have gone into the calculation of the estate tax. And if I click on annual amounts across the top, I can click on a particular item, such as lifetime taxable gifts, and it will give me more information on how it got to the numbers. For example, this is showing me every year. If it's doing annual growth on the investments, this is how it's determined how much investments there will be, including reduction by the qualified personal residence trust payments. So it's sort of an accounting to show the user where we are. Now, going back to trust logistics, so far I've shown you everything down to the qualified personal residence trust and gifting. And for example, if you wanted to know how much estate tax would it save me if I were able to get a 35% discount instead of a 30% discount? I can just click from 30 to 35% on the left, and you'll see the estate tax goes from 28,000,004 to 28,000,003. Okay, got to fix that. Okay, so let's say that I would like to know what would happen if I could increase my discount for gifting from 30% to 35%. Okay, so right now I'm showing a 30% discount for gifting. I can click on discounted gifting, and as you see, with a 30% discount and the assumptions I have here, the estate tax is 26.8 million. Well, what if I can take a 35% discount? If I click up from 30 to 35, you see that number go from 26.3 million to 26.8 million. You see the gifting trust go from, let's say at 25% discount, 3,000,007 to a 35% discount, 4,000,002. So as you make changes on the left, your picture in the middle immediately changes. The next module I have is a life insurance module, and this allows me to have multiple life insurance policies on the life of the client and second to die policies, assuming that the client is the surviving spouse. So I can click on add pre-planning policy, and then what comes up is in yellow there. I can provide whether it's in an irrevocable life insurance trust. I can provide whether it's in an irrevocable life insurance trust, also known as an ILIT, whether it's term or permanent. If it's term, the number of years of the term policy, the annual premium, and the death benefit. Now, if I'd like to show the client that this would be a 20-year term policy, it's not in an ILIT, but I want to show the client what happens if it goes into an ILIT. So I click on this pink copy pre-planning policy to post-planning. Now I have the same term policy in pink, and I can click on ILIT. So now this is going to show me what happens if I have this policy first before going to life insurance trust outside of an ILIT, 26.9 million in estate tax. And then if I click on life insurance trust, now it's in the ILIT. You see it turn purple. It's not subject to estate tax. The estate tax goes down a little bit. The gifting trust goes down a little bit because the premiums dollars that would have gone into the gifting trust are now going into the life insurance trust. So it's a pretty big difference. Now, I can go back to life insurance and I can add as many policies as I want. So let's add one more pre-planning policy. And let's say that this policy is a permanent policy. They're going to pay $8,000 a year for 12 years and then $4,000 a year for 15 years and have a $1 million death benefit. And so then I can add post-planning to that by clicking on post-planning as to this policy that I just added. By again clicking on copy pre-planning policies to post-planning. Now I've got the pre-planning outside of an ILIT and the post-planning identical permanent policy in the ILIT. And now when I click discounted gifting before life insurance, you see more life insurance. And when I click on life insurance trust, you see it turn purple and a lower estate tax, but again, a lower gifting trust to take that into account. So this client still has a $26 million estate tax situation. It's better than it was, but the next thing I can do is evaluate whether I want to give a large gift to the irrevocable trust using discounts, or whether I want to do an installment sale or some combination thereof. So if he were to make a $12 million large gift using a 25% discount, so he gets 12 million of his investments out of his estate, calling it a $9 million gift, then when I click on large gift, you see that estate tax goes down from 26 million to 11 million, and you see that gift trust with 48 million in taxes. And you see that in year 18, he is not running out of assets. He's still got that explosive asset in his estate, but this is the advantage of gifting. Now, instead of gifting, or in addition to gifting, we can consider going to an installment sale. So I'm just going to turn off the gifting large gift here, and I want to show you our installment sale arrangement. So I'll open up the input so it's a little bit easier for you to see and for me to see. And we have only one spouse here, and let's say that he intends to put $12 million into an LLC, take a 25% discount. Let's make it 12,200,000 goes into an LLC. He takes a 25% discount. 99% non-voting member interest in that LLC is worth about $9,150,000. And before selling this 99% LLC interest to an irrevocable trust for $9,150,000, he's going to make a $915,000 gift to the trust, a seed capital gift. This is a rule of thumb used in the industry. It's not required, but it seems to be fairly safe and well respected. And part of what he's going to do here is give a portion of his explosive asset as well. So what we have is a $9,150,000, and I'm sorry, so he's also going to give a portion of his explosive asset as well. So I'm going to click on transfer a part to installment sale and assume that he'll put 50% of his explosive company. So 50% of the appreciation, 50% of the capital gain is going to go into that installment sale. So his total sales price is $10,650,000. Okay, I'm going to start all over on the installment sale. Okay, so I've turned off the large gift calculator. Now I'm on the installment sale calculator. Let's say that he puts $12,200,000 into an LLC, takes a 25% discount, and values a 99% interest in that LLC at approximately $9,150,000. He's going to sell that LLC interest to this irrevocable trust that's disregarded for income tax purposes after he makes a $915,000 gift to make sure that the irrevocable trust has a decent net worth. He's going to receive interest at 4.5% a year, or actually we can see the applicable federal rate. The lowest of the three can be 4.14%. interest, we can make it a 15-year note. We know the annual payments will be $378,000 a year, and he will pay the income tax on the trust income. If he dies during the term, then we'll take a 15% discount on the note, knowing that an applicable federal rate note is not worth the face value of the note. Let's just take a 5% discount there. And if he was going to have a guarantee fee paid in exchange for somebody guaranteeing the note, you could click there and put in your guarantee fee. So let's go back here and see what that little installment sale does for this family. I click on year one gift, installment sale, and now the estate tax goes from 18 million to 5,961,000. By the way, I'm just going to so the difference between no installment sale, $18 million in estate tax versus installment sale where it comes down to $5,600,000. And you can see here at the top, his investments are lower because the installment note trust has 13 million of non-discounted investments. It owes the note of 9,150,000, which is now in his estate. So the net value is 4 million that we're getting out of his estate in the year of the sale, using only 950 of his exemption. And in year 18, that beautiful trust has 32 million of assets, and his investments are down to 27 million. So the estate tax is 5,000,009. Now, he may want to do more. That looked pretty good, didn't it? So what I could do here, and it saves a lot of time, is I can just click up on the 12,200,000 that's going into the LLC and keep clicking that up until if I can see if the estate tax goes away completely. And it sure does. If I put 19,950,000 into the LLC and make $1,496,000 gift, I've completely eliminated estate tax, and that is wonderful, isn't it? But what happens if he dies during that time? If he dies early, I click on timeline and I see that he only has 0 estate tax if he lives all the way up there. So to eliminate this more, I can go over here and keep clicking that installment sale up until he basically runs out of other assets. Now, he may or may not want to do that, but it's certainly informative. If he'll also put his exploding asset into the installment sale, I can click on exploding asset and have a significant savings on the exploding asset as well. So that gives you a pretty good view of how the installment sale calculator works and how the explosive asset works. The explosive asset is very interesting because the bigger it is, the bigger the capital gains tax when he dies. And that can actually wipe him out completely, depending upon when the explosive asset is going to be sold and how much tax there's going to be as the result of the sale. And also what discount you're going to use. So all those go together very nicely. Okay, so now I'm going to turn off the installment sale here by clicking off the installment sale. And let's say that this is a very charitable client. So I'm going to go back to Trust Logistics here, and I'm going to say, look here, you've got a $31 million estate tax. Would you like to have 0 estate tax and leave it to charity? And the client says yes. So I can click on charity here on the bottom left-hand side, and then I can click on testamentary charity. And this tells me that if 78,140,000 goes to charity, there'll be no estate tax, but the beneficiaries will only get 35 million because so much went to charity. It actually cost them 46 million of inheritance to zero out the estate tax. So I can show that again. Without planning, the descendants get 82 million. Uncle Sam gets 31 million. With the charity, the descendants only get 35 million, and the charity gets 78 million. So the children say, is there another way to do this? And one way to do it, would be to use a charitable lead annuity trust. So I click on charitable lead annuity trust, and let's say they want to completely zero out the income tax, and that they expect that with the charitable lead annuity trust, a good result would be about 50% of the asset value going to the charity over the term of the charitable lead annuity trust, and the remaining going to the descendants. So now I show zero estate tax, the descendants getting 35 million initially, 39 million after 20 years, for a total of 74 million, not adjusted for time value of money, and the charity actually getting 39 million. Now, of course, maybe they would like to make a large gift now to reduce that estate tax exposure. And then if they were to do that and the charitable giving, the numbers would be a bit different. Now, if I check on the large gift to the trust, I've got the charity reduced from 39 million to 20 million, and I've got the descendants getting 73 million initially, and then another 20 million in 20 years. So we can play with these numbers to get them where we want them to go. And once I have this where I think I want it to be, and what I suggest for the client, which could be a large gift and an installment sale, by the way. In fact, I'll click them both. And then I wouldn't need anything for charity. Now I can click on Generate Client Letter, and I can select all of these alternatives. I won't need testamentary charity. I can show the introduction, a timeline, and all the calculation details, and I click on Generate Client Letter. After I click on Generate Client Letter, the computer talks to me. Thank you. So now I'm going to open up this Word document that the computer just prepared. This is not artificial intelligence, by the way. It is spreadsheet logic, but in any event, it explains the federal estate tax for the client. It provides all of the all of the input information that we placed into the assumptions, and then it explains each of the planning strategies, showing the charts for each of the planning strategies. And this is in a modifiable Word document that you can then update to your heart's desire. In addition, I can generate a PowerPoint by simply clicking on Generate PowerPoint. The computer is now generating a PowerPoint that will have each of those illustrations. It doesn't talk when you click on Generate PowerPoint, only when you click on Generate Client Letter. But then I go to my arrow down here on the top right-hand side under my Google Chrome, and there I can open my comprehensive planning PowerPoint. Now, this is assuming the exemption goes down to half. What if the exemption doesn't go down to half and I want to show the client that scenario? Well, I can go to the left-hand side here, and I can find where I selected that the exemption goes down to half. And as soon as I unclick that, all of the displays change. Now the exposure is still significant, but completely handled by the installment sale. So now I can click on the letter again, I can click on the PowerPoints again and just show the client, here's the total result if the exemption goes down, here's the total result if the exemption doesn't go down. Another thing I can do is I can go to the Monte Carlo calculator that we have and say, look, for your particular portfolio, the rate of return that we chose of 8% is middle of the road. If you actually earn 11%, which is quite possible, we'll click this up to 11%. And now there's a bigger problem. There's a bigger estate tax problem if we don't do the planning, and you could print that. You could print it with and without the large gift. It does take some time to do this, but when you run the numbers, you will have a much better insight into what the client may want to do, and you'll be educating the client on what to do. Now, I can go to File and Save As, click File, Save As, put in the client name, John Singh, click Save, and now this is saved to my computer. So the next time I come back to my computer, I can go to File, Open, and I will find the John Singh item in my computer. I'll click on it, and it'll automatically open all of those inputs. I can also click on Share with Client. It assigns me a code. I can change the code if I want. I click on Generate URL, click on Copy to Clipboard. Now I start an email to the client and the financial advisor and the CPA and the other lawyer, and I say, I've just run this scenario. I've just videotaped on Zoom or GoToMeeting, watch the videotape, and then click on HTTP, tinyurl.com, etc., and use code number 175246, and you'll have 14 days to use this and modify it to see which strategies the client would like to use. So the other aspect of this planning is the ability to do the same thing with a married couple. So when I click Home and Married Couple, you're going to see the same arrangement, the only difference being, of course, that now you have two spouses, and you have spouse one, and then you have spouse two. So I can click here, here's spouse two, here's his or her age, and then this is going to tell me not only the actuarial year of death for spouse two, but also the actuarial year of joint and survivor death. In other words, if you have somebody of these two ages, then there will be a 23-year expected life expectancy as opposed to a 21-year life expectancy. One of these two has at least a 50% chance of making it to year 23. The other thing different for the married client is that the annual additions to the portfolio from outside income, which happen for the first dying spouse, are for both of them. But after the death of the first dying spouse, you custom set what that income or loss will be. And remember, it's not the income from the portfolio of investments or the exploding asset. It's what the person or persons spend in excess of what comes in. If they only have Social Security coming in of $20,000 a year and they spend $120,000 a year, then they have a net outgo of $100,000 while their investment portfolio continues to grow. And if you ever want to have that explained to you, you can click on the explained button, and then it tells you where you are as far as additions or subtractions from the portfolio, depending on where the client is. So that is definitely a useful tool. Another thing when you're with the married couple is you can click on life insurance estimates. When you click on life insurance estimates, it'll show you the life insurance situation and life expectancy situation for both of them. So you can then find out what a term life or a universal lifetime pay policy might typically cost based on whether they're standard or preferred, and use those numbers in your planning. Other than the above, I would, how do you get rid of this? Go away. To close the life insurance estimates, you click on the red X and it goes away. With a married couple, I have the ability to do multiple CUPERTs. So I'll click on CUPERT, and there you see I can do 1 CUPERT or 2 CUPERTs. Now a married couple can do 3, but our comprehensive display module here only allows 2. You could run the numbers for 3 on our separate CUPERT calculator. And then this does show a considerable amount that gets added to the CUPERT in cash. So those are the key features of our single person calculator and what's different when you use a married couple. Thank you very much for your attention to this presentation, and we thank you very much for using or trying out EstateView software. We want to make this software as good as we can, so we welcome your questions, comments, and suggestions. Thank you very much. Have a great day.